I have Ashutosh Bishnoi. He's the director at Multi-Act. It's a house which provides research and advisory to big influential family offices across the country. Biren, Ashutosh, thank you very much for joining us. We have interacted with you quite a lot in your previous avatar at Manulife, but good to have you today at Multi-Act. So Ashutosh, let me understand from you the choice of this role. How do you see this entire family office kind of structure taking shape in India, that you have also chosen this as your next innings?
Sure. Thanks, Ajay, for having me. And yes, you are absolutely right. What's happened in the last about 20 odd years in India, that a tremendous amount of wealth has been generated by successful business families. It was there before, but now many of them have turned to the route of establishing a professional setup. That setup then has experts from investment markets who try to structure long-term portfolios for families. In all the reports that I have read, the sense I get is there may be about somewhere between 500 to 600 families in India who have structured either a rudimentary or a well-organized office consisting of anywhere between 1 to 8 or 10 people who structure the family's investment portfolio. Of course, the family office concept goes beyond that a little bit. It gets into governance of the family, the succession, and things like that as well. But by and large, we at Multi-Act keep ourselves focused on the investment side. And in this space, more and more experts are coming into play. The real issue here that I find that families are faced with in India is when you've generated so much wealth, and a lot has been generated, recently by what you call the techpreneurs in India. They are really faced with the challenge of how do you keep this wealth intact over a long period of time. A lot of activity is happening there. Then family offices take exposure in the Indian market through all the registered intermediaries, whether they are asset managers, they are wealth managers, they are other investment styles or manners, through brokers. So there's a whole variety of people who are representing the family office wealth through legitimate registered vehicles today. That's the manner in which it happens. Typically, Ajay, what we found 25 years ago when Multi-Act was set up, that a family office would hire the services via its experts of different asset managers, product providers. There could be mutual funds, there could be PMSs, there could be AIFs, there could be structured products. And they would, the basic office would then sort of assimilate them, assemble them like a portfolio and manage. We found, sorry.
Go ahead.
We found that most of these offices, these families, were ending up in the long term with index-like returns, but holding a cost of management, which was anywhere between 2 to 3%. So, which then didn't look like a very attractive way to manage family funds. So Multi-Act founders, who were themselves a business family, set up Multi-Act for their own purpose initially. And for the first decade or so, all that Multi-Act did, hiring research people, was to manage 1 or 2 families' money only. And then they found that they could do better than long-term index-like returns. The idea is to provide anywhere between 200 to 400 basis points better than benchmark. At the same time, reduce the cost. So that's the focus with which I think family offices today are discovering that they should work.
Ashutosh, traditionally, I want to also understand these are conservative structures, right? Family offices. What kind of returns on the market, especially when this kind of a buoyant and super charged up market, how are the return expectations? Are they moderate? Are they very kind of on a more sustained basis? Talk to us about how they analyze market differently from an ordinary investor.
So what we do is when we engage with the family, we talk to them about the fact that the global experience has been that serious wealth seldom goes past the third generation. I mean, this is the truth. I would say 80 to 90% of the cases, it doesn't go past the third generation because it wasn't shepherded well enough. So we talk about creating a 100 to 150 year portfolio. When you look at that kind of a long range portfolio, you don't want to fall into behavior traps in the near term, but it does happen. I mean, we've seen families, we try to advise them against. I'll give you an example. A couple of years ago in India, there was a lot of new age tech companies going IPO, right? And we just felt that there were some good businesses there, but somehow the valuations looked a little bit on the rich side. And we advise most of the families to say, please don't fall into this behavior trap of the fear of missing out. You will miss out nothing. Some of the good businesses will survive. You'll get them at good valuations. So events like this, the market serves up, and particularly in India, it's a growth market, right? And you will see tremendous number of people coming out with new opportunities. New AIFs are launched all the time. People are talking about private credit, about long shots, and family office team, which is maybe a 3 or 5 people team, many times can fall into a behavior trap of saying, can I really miss this out? Can I sit this one out? And we sort of work with them to work a 100-year portfolio. And the returns on a 100-year portfolio, like I said, if you can do better than the index, 250 basis points consistently after all your costs, I think you would have made a tremendous wealth survive. That's very difficult to do. All long-term managers will tell you that. Yes, many people will give you 25% in 2 or 3 years. But 100 years? That's like, if you talk about 35-year index, today's S&P 500, it runs at 9.5 or around this, they're around 9.5 CAGR, right? Can you do 12% in S&P 500 US? You would be supremely rich over 100 years. Now, that's the kind of focus we try to bring into the market, and it cannot be done unless you are very disciplined and you stop yourself from falling into traps. Even so, for example, we run portfolios for some of our clients through an asset management arm. And I have a very favorite portfolio in this. We call it the all seasons portfolio. I used to call it the cockroach portfolio. It is created to survive all holocaust. So, but this portfolio runs at about 300 basis points better than the risk-free rate of return over a very long period. Now, a family would certainly want its long-term wealth meant for its third and fourth generation parked there. That's the behavior we see all the time. Yes, there will be some play money, if you like. Maybe 10% of it, you want to take some quick bets, you want to get the excitement of the market. But I have not seen the number go beyond 20% ever. That's the max.
Right, that's a very interesting way, Ashutosh, you put your point forward. The cockroach portfolio, the portfolio which is anti-fragile and last and outperform the benchmarks over a long, really long, decades, I would say, period of time. That's something you're focusing on right now. But thanks very much, Ashutosh, joining us on the show today. That was Ashutosh Bishnoi of Multi-Act talking about how the big family office money is looking at investing and the right approach they should actually take to outperform the market.